Bernard Madoff, the man who defrauded thousands of investors out of billions of dollars. Initially, Madoff was a well-respected figure on Wall Street. He was the former chairman of NASDAQ, and his investment firm promised steady, above-market returns. But behind the scenes, Madoff was running a massive Ponzi scheme. Instead of investing his clients' money, he used it to pay returns to earlier investors and fund his lavish lifestyle. Everything came crashing down in 2008 when the financial crisis hit. Madoff couldn't keep up with the withdrawals, and his scheme collapsed. The revelation devastated thousands of families, wiping out life savings, retirement funds, and charitable foundations. Bernie Madoff was tried and sentenced to 150 years in prison, but the scars he left on his victims remain. His story serves as a stark reminder of the devastating impact of financial fraud and the importance of vigilance in the world of investing. Want to learn more trading tragedies? Hit subscribe for more. Have you heard of Jesse Livermore, the man who made and lost fortunes on Wall Street? Livermore was a legendary trader in the early 20th century, famous for his incredible wins and devastating losses. He famously shorted the market during the 1929 crash, making millions, but his fortunes didn't last. Despite his brilliance, Livermore's risky bets eventually led to bankruptcy in 1934. His mantra, "The game of speculation is the most uniformly fascinating game in the world," reflects his belief in the excitement and peril of trading. His story is a powerful reminder of the highs and lows in the world of trading. Want to learn more trading tragedies? Hit subscribe for more. Ever heard of the Wolf of Wall Street? Jordan Belfort, a notorious stockbroker, made millions in the 1990s through his firm, Stratton Oakmont. Known for his lavish lifestyle and aggressive sales tactics, Belfort defrauded investors with high-pressure sales and fraudulent stock schemes. Despite his mantra, "Act as if you're a wealthy man, rich already, and you'll become one," his fortunes didn't last. The law caught up with him, and he was sentenced to prison for securities fraud and money laundering. His story, filled with excess and deception, serves as a powerful reminder of the dangers of greed and the importance of integrity. Want to learn more trading tragedies? Hit subscribe for more. Have you heard of Ivan Boesky, the infamous trader from the 1980s? Boesky made a fortune through insider trading, using non-public information to make huge profits on Wall Street. Known for his aggressive tactics, he became a symbol of greed in the finance world. His mantra, "Greed is all right, by the way," reflected his ruthless approach to winning in the markets. However, his empire crumbled in 1986 when he was caught and charged with insider trading, leading to a $100 million fine and a prison sentence. Boesky's fall from grace is a stark reminder of the dangers of unethical practices in trading. Want more trading stories? Hit subscribe for more. Ever heard of Michael Milken, the junk bond king? In the 1980s, Milken revolutionized finance by popularizing high-yield junk bonds, enabling companies with lower credit ratings to access capital. His aggressive trading and innovative financial strategies earned him immense wealth and power on Wall Street. However, Milken's success came with a dark side. He manipulated the bond market by engaging in insider trading and creating a network of traders to artificially inflate bond prices. Milken's mantra, "Prosperity belongs to those who learn new things the fastest," drove his relentless pursuit of profit. In 1990, Milken pleaded guilty to 6 felonies and was sentenced to 10 years in prison, later reduced to 2 for ratting on his co-conspirators. His story is a cautionary tale about the thin line between innovation and illegality. Want to hear more trading tragedies? Hit subscribe for more. John Gutfreund, or the King of Wall Street, as he was called. In the 1980s, Gutfreund was the CEO of Salomon Brothers, one of the most powerful investment banks of the era. He turned Salomon into a trading powerhouse by pioneering the use of mortgage-backed securities and aggressively expanding its trading operations. Known for his aggressive and competitive nature, Gutfreund's leadership pushed Salomon Brothers to the forefront of Wall Street. However, his downfall began with a bond trading scandal. In 1991, Salomon Brothers was caught submitting false bids to manipulate U.S. Treasury auctions. After getting caught, he was forced to resign, and Salomon Brothers faced heavy fines and increased regulatory scrutiny. Gutfreund's mantra, "Greed is good," reflected his approach, but it ultimately led to his resignation and tarnished legacy. His story is a stark reminder of the perils of unchecked ambition. Want to learn more trading tragedies? Hit subscribe for more. Have you heard of Victor Niederhofer, the trader who rose to fame in the 1980s only to lose it all? Niederhofer was a successful hedge fund manager known for his aggressive trading strategies and big risks. He used quantitative analysis to identify market trends, betting heavily on them. This approach led him to make millions, but it also had a dark side. In 1997, he placed a massive bet on the Thai baht, convinced it would hold steady despite emerging market volatility. However, when the Asian financial crisis hit, the baht collapsed, wiping out Niederhofer's positions almost overnight. His strategy didn't account for extreme market conditions, leading to catastrophic losses. His mantra, "Always trust your analysis but never ignore the risks," reflects the lessons he learned the hard way. His story is a cautionary tale about the dangers of overconfidence, over-leverage, and the unpredictability of global markets. Want to learn other trading tragedies? Hit subscribe for more. Have you heard of John Meriwether, the man behind one of Wall Street's biggest collapses? In the 1980s, Meriwether rose to fame as the head of bond trading at Salomon Brothers, known for his aggressive and innovative strategies. He later founded Long-Term Capital Management, LTCM, a hedge fund that initially saw massive success by using complex mathematical models to predict market movements. But in 1998, LTCM made highly leveraged bets that backfired when Russia defaulted on its debt, leading to catastrophic losses. His mantra, "Trust in the math," proved disastrous when the models failed to account for extreme market conditions. The near collapse of LTCM sent shockwaves through global markets and required a $3.6 billion bailout by major banks. Meriwether's story is a stark reminder that no model can predict every outcome. Want to hear more tragic trading stories? Hit subscribe for more.